Welcome to another deep dive. Today we're tackling investing.
Investing, yeah.
Specifically, the ideas in the Little Book of Common Sense Investing by John C. Bogle.
Oh, yeah, John Bogle.
Founder of Vanguard, and really like a pioneer in making investing more accessible.
Yeah, for sure. And the creator of the first index mutual fund, so.
Exactly.
Yeah.
So he calls investing, or at least for most people, a loser's game. I definitely want to dive into that because when I hear loser's game, I think, well, investing is how people make money, right?
Yeah. Well, so he uses this really interesting story, the Gottschalks family.
Okay.
And basically, they own 100% of a fictional company's returns.
Got it.
But as they bring in more and more helpers, stockbrokers, advisors, fund managers, their share of the pie shrinks dramatically.
Ah, so all those fees and commissions they're charging.
It's death by 1,000 cuts.
Yeah. It really is.
And this actually aligns perfectly with Warren Buffett's fourth law of motion, which states, for investors as a whole, returns decrease as motion increases.
Oh, I like that.
So the more you're trading, the more you're paying in fees, the less you're actually earning.
That's a great point.
Yeah. And John Bogle was very outspoken about the inherent conflict of interest between investors and the financial industry.
I mean, you can see that, right? The more the financial industry, I guess, churns, the more money they make.
Exactly.
Right.
And another cornerstone of his philosophy is understanding the distinction between what he calls the real market and the expectations market.
I mean, I've heard these terms, but help me understand, like, what's the difference?
So the real market is driven by business fundamentals, earnings growth, dividends, the actual performance of the company.
Like, how's the business doing?
Exactly.
Yeah.
The expectations market is driven by speculation, emotion, short-term swings and sentiment.
So that's like almost what people think it's worth versus like what it's actually doing.
Exactly.
Yeah.
And far too many investors get caught up in that expectations market.
Oh, yeah. FOMO,
Exactly. Chasing returns, trying to time the market, which, let's face it, is nearly impossible to do consistently.
Impossible, yeah.
And so that's where Bogle's famous idea of indexing comes in.
Okay.
He says we should cast our lot with business.
Okay.
By simply owning the entire stock market through a low-cost index fund.
So instead of trying to pick and choose winners or losers, you just own the entire market.
Own it all.
Yeah.
It sounds almost too simple, right?
But yeah, it is.
But that's the beauty of it.
Right.
Keep it simple, stupid.
Yeah.
Right. He was a big believer in that index funds track broad market indexes like the S&P 500.
Got it.
So you're automatically diversified.
So I'm sure some people listening are thinking, well, won't you miss out if you do that, right?
Right.
Like, what if there's a particular sector
right
that you think is going to do really well, or you think you can pick the stock that's going to,
you're going to 3 or 4x this year or something?
Yeah.
It's exactly. Well, his research showed that the vast majority of actively managed funds, so those with managers picking stocks, actually underperform the market over the long run.
Interesting. So are they just bad at their jobs?
I mean, some are certainly better than others, but there's a bigger factor at play here. Costs.
Ah, okay.
He called it the relentless rules of humble arithmetic.
Okay. I mean, I get that it makes sense, but break it down for me.
So it's simple. Market return minus costs equals investor return.
Right.
Every dollar you pay in fees, expenses, trading costs, that's a dollar not working for you.
That makes sense.
And those costs, they compound over time.
Yeah, so it's like, you think about like a leaky tire.
Yeah, exactly.
It's just slowly losing air.
Right.
Okay.
And it's not just expense ratios, right? We're talking sales charges, portfolio turnover, taxes.
I haven't thought about all that.
Yeah, hidden costs.
That are often overlooked.
Yeah, because even if you think, okay, I can find a really great fund manager.
If they have all these costs that are eating into it.
Exactly.
They might have a good strategy, but it's not going to end up.
It may not be enough to overcome
all of that.
Those costs.
Oh, interesting.
And, he provides some data to back this up.
Okay.
He shows that the average investor in an average equity fund earns far less than the actual return of the fund itself.
Wait, so if the fund is doing well,
how
are the investors doing worse?
Investor behavior.
Ah, okay.
People tend to buy high, sell low.
Yeah, I've heard of that.
Chasing past performance.
Got it.
Getting spooked when the market dips.
Oh, so it's that emotional side.
Exactly.
Got it.
And he calls that the grand illusion, right?
Yeah.
They think they're going to get the returns of the fund, but their own behavior
Is messing it up.
Is what's killing them.
Got it. Okay.
And this is where the tax efficiency of index funds comes in as well.
Yeah.
Because they have very low turnover.
Okay.
They generate fewer taxable events.
Oh, so you're saving money both on the costs and potentially on taxes.
Double win.
Okay, I like this.
Yeah, and this becomes even more crucial when you consider future returns.
Okay.
Bogle acknowledges that past market performance is no guarantee of future results.
Right.
And he argues that we might be entering an era of lower returns overall.
Okay, so if returns are going to be lower, we have to be even more careful.
Even more so.
About those costs.
Costs are everything.
Okay.
In a lower return environment, every basis point counts.
Yeah.
And he actually shows that low-cost funds consistently outperform high-cost funds.
That makes sense.
Yeah, and this holds true across different market cycles.
Okay, so you're painting a pretty compelling picture here for index funds.
It's hard to argue with the data.
Yeah, I mean, is it really just that simple? Just pick an index fund?
I mean, at its core, yes.
And just write it out.
Write it out.
For decades.
That's the Bogle approach.
Okay.
He believed that owning the entire stock market through a broad index fund
is the most sensible and effective way to build wealth over the long term.
And I think he calls this the majesty of simplicity.
The majesty of simplicity.
It's a good one.
It is.
But I'm sure some people are thinking, okay, well, what about the criticisms of this?
Of course.
Right.
Yeah, I mean, like...
Everyone's a critic.
Like, are they too passive?
Right, they're just tracking the market.
Yeah.
They're not trying to outperform it.
Like, is everyone going to start doing this, and is it going to mess things up?
Right. Will it lead to market inefficiency?
Yeah.
He addressed these head on in the book and makes a strong case that they are largely unfounded.
Okay.
He provides evidence.
He's got data.
He's got data, logical arguments
to
debunk those myths, and ultimately concludes that the benefits outweigh any perceived drawbacks.
So let's shift gears for a minute, because we talked a lot about stocks.
Yeah.
But what about bonds?
Right.
Why are bond funds important?
So bonds play a crucial role in balancing out the risk in a portfolio.
Got it.
They tend to be less volatile and provide a steady stream of income.
Okay.
Bogle explains that bond fund performance is influenced by three main factors.
Okay.
Interest rates, credit quality, and maturity.
Okay, so you got to look at those things too.
Gotta understand those, yeah.
I can't just pick any bond fund.
Pick a bond fund, right?
Okay, so I feel like I'm already getting like a master class in investing here.
Well, we're just scratching the surface.
Yeah, no kidding. But before we move on, we got to talk about, you mentioned earlier, all the new stuff that's going on.
Yeah, all the new trends.
Crypto, meme stocks, all this stuff.
Right.
Like, I got to imagine Bogle would have some thoughts on all this.
Oh, he definitely would. So we're going to dive into those and a lot more when we come back for part 2 of our deep dive.
Awesome. I'm looking forward to it.
Me too.
Okay, so welcome back to the deep dive. And one thing that I'm thinking about is we keep talking about how, like, investing is counterintuitive.
It really is.
Bogle's approach.
It goes against all of our instincts,
It does, yeah.
As human beings.
As humans, we want to do stuff.
We want to feel like we're in control, right? We want to take action and...
We want to feel smart.
Yeah.
But it's like, you're telling me don't do anything.
Less is more, right? Don't just do something, stand there.
Yeah.
That old adage, right?
That's it.
But with investing, it's the opposite. Don't just stand there, do something.
Or do something, just stand there. Yeah.
Yeah, exactly. It's so powerful, but it seems so simple.
Yeah.
And it's hard because there's so much noise out there.
That's the thing.
Telling you to buy this, sell that.
Yeah.
Do this, do that.
Everyone's got a tip.
Hot stock tip.
Yeah, exactly.
Ugh.
This is what I was thinking about, too. It's like, we hear all these stories about these people who made a killing, right?
Yeah, the outliers.
The outliers.
The people who,
timing the market perfectly.
They traded their way to millions, yeah.
Yeah, exactly. It's like, well, doesn't that mean Bogle's wrong?
Well, he acknowledges those exist.
Right.
But it's not replicable.
Yeah.
On a large scale, you can't create a system.
It's luck. It's not skill.
Right. Yeah. It's like winning the lottery.
Got it.
It happens, sure, but you wouldn't base your retirement plan.
Yeah. You wouldn't bet your life savings on it.
Yeah, you wouldn't.
Okay.
So yeah, and speaking of, I guess patience and discipline,
yeah.
we talked about all these new trends.
Right. The cryptos, the meme stocks, fractional shares.
All this stuff.
Yeah.
Bogle would, I think, come at this with a healthy dose of skepticism.
Well, especially in crypto, right? Because crypto is so volatile.
And it seems to be based purely on speculation.
It's like, what's the intrinsic value?
And are you actually buying?
Right. I don't know.
I'm not sure either, right? Bogle was all about investing in things with intrinsic value.
Got it.
Companies that produce earnings.
Yeah. I don't think you can say Bitcoin's producing any earnings.
No dividends from Bitcoin?
No, that's true.
Right. And then meme stocks, right?
Yeah, that stuff on social media.
Driven by social media,
Reddit, all that.
Yeah, wild price swings.
Yeah, exactly.
He lived through the dot-com bubble.
Right.
So he knew
it all.
Yeah, he saw it all. He knew the dangers of this type of speculative frenzy.
And he probably would have said, hey, you got to focus on the fundamentals.
Don't get caught up in the hype.
Don't get caught up.
And remember, he wrote Common Sense Investing.
Yeah.
During a time when day trading was all the rage.
Oh, wow.
So that was the hot new thing, was day trading.
Got it.
And he was railing against that.
So I'm sensing a theme here.
Yeah.
He's not a fan of get-rich-quick schemes.
He's a long-term investor.
Okay, now fractional shares?
Yeah.
That seems a little different.
It is different.
Right. Because you can buy portions of expensive stocks.
Makes it more accessible.
Yeah.
Yeah. I think he would have appreciated that aspect of it.
Okay.
Making investing more accessible.
Yeah.
But he also, I think, might have been concerned about, again, the speculation.
Right. So it's like, it's a tool that can be used.
It can be used for good.
For good or for,
Well, for bad, right?
Yeah, you could.
It depends on how it's used.
Yeah, you could get caught up in the hype.
Easily, yeah.
Okay, but let's go back to the book for a second, because one thing that I thought was really interesting
was
Bogle's point about owning a mutual fund versus owning the stocks directly.
Yeah.
And how there's a difference.
Huge difference.
You think, okay, I'm diversifying.
If a mutual fund, you're good to go, right?
Right. Not necessarily.
But it might be that fund is heavily weighted.
Right. It's concentrated in a few sectors.
In like one sector.
Our industries.
Yeah.
Right.
And if that sector goes down, oh, you're in trouble.
Your portfolio's hurting.
Yeah.
Okay.
You got to look under the hood.
So it's like, okay, you might be buying a cereal that says it's healthy.
Right.
But then you look at the ingredients and it's like...
all sugar.
All sugar.
Yeah, it's all marketing.
Okay, but...
you got to do your own research.
Yeah, you got to do your homework.
Due diligence.
Okay, so now you got to check the funds in your fund.
Right, right.
But I got to imagine some people are thinking, okay, this all sounds well and good.
Yeah.
But
it's boring.
It's boring.
Right.
Like, where's the fun in just buying and holding?
Where's the excitement?
For decades.
Yeah.
Like, what am I supposed to do?
Well, Bogle had an answer for that, and actually it was pretty funny.
Okay.
He said, set aside maybe 5% of your portfolio for funny money.
So like 5%.
5%.
You can do whatever you want with.
Go nuts.
Go nuts.
YOLO.
But the other 95.
That's your core.
Stay the course.
Stay the course. That's your long-term plan.
I like that. Okay, so
you can have a little fun.
You can have a little fun.
But don't
bet the farm.
Don't bet the farm.
Yeah. But that brings me to another question.
Yeah.
What about when things go bad?
Bear markets.
Bear markets.
Everybody's favorite topic.
Right. It's like, okay,
right.
Index funds are great when everything's going up.
Yeah.
But what happens when the market tanks?
Then what?
What do you do?
Yeah.
Well, Bogle actually addresses this head on in the book.
Okay.
And he basically says, look, bear markets are a natural part of the cycle.
Okay.
And you can't avoid them.
You can't time the market.
Don't even try.
So we just got to accept
that they're going to happen.
That they're going to happen.
And ride it out.
Ride the wave.
Ride the wave.
So you're saying don't panic sell.
Don't panic sell. That's the worst thing you can do.
He would say that's the worst thing.
Historically, the market has always recovered
from bear markets.
So it's like, okay.
It's like a deep breath.
Deep breath.
Ride it out.
Okay. Now I like this.
Yeah.
It's like a totally different way.
It's a mindset shift.
Of thinking about investing.
Short-term panic to long-term opportunity.
It's almost like those bear markets are a chance to buy
low.
To buy low.
Right.
Okay. And this brings us to the power of compounding.
Compounding, baby.
Right, because the longer you stay in.
It's where the magic happens.
The more the
snowball effect.
Yeah, it just keeps building.
It's still getting bigger and bigger.
Okay, I'm starting to see.
Yeah, it clicks eventually.
This is all making sense now.
Yeah.
But I have one last question.
Yeah.
Okay, so you convinced me.
Yeah.
Index funds are the way to go.
Right.
But how do I actually pick one?
Yeah, right. So many to choose from.
There are so many.
He actually makes this easy too.
Okay.
Stick with low cost,
Okay.
broadly diversified index funds
Got it.
that track major market indexes,
Okay.
like the S&P 500 or the total stock market index.
Total stock market.
Yeah.
So that's like
That's like the whole enchilada, the whole shebang.
Okay. He even provides a list.
He does. He names names.
Oh, really?
Yeah.
Wow. He really wanted to make this.
He made it easy.
Easy.
He did.
Okay. Before we wrap up part 2, let's do a recap.
Recap. All right.
What have we learned?
All right.
All right. Welcome back to the deep dive.
Deep dive round 3.
Round 3. Here we go.
Let's do it.
It's time to wrap up.
Wrap it up.
All this Bogle wisdom.
All this Bogle goodness.
And try to boil it down.
Distill it.
Yeah, distill it, exactly.
Analyze it.
Into some key takeaways.
Actionable advice, yeah.
For our listeners?
For sure. I mean, we've been talking for a while now.
Yeah, we have.
About the loser's game.
Right.
Index funds.
Keep tuning out the noise.
All that good stuff.
I mean, my head's spinning a little bit.
It's a lot, yeah.
In a good way.
In a good way.
But I'm like, okay, how do I put this into practice?
Because let's simplify, right?
Simplify.
Key takeaways.
Yeah.
I think it all starts with Bogle's relentless emphasis on simplicity.
I mean, he really wanted to just make investing clear.
Cut through the jargon, make it accessible. Yeah. You know, you don't need a PhD in finance to be a successful investor.
And he would say, in fact, simpler the better.
The simpler the better, yeah.
Don't outsmart yourself.
Exactly.
Keep it easy.
Keep it easy.
Which leads perfectly into the second thing, costs.
Costs.
He was obsessed.
Obsessed.
With keeping those costs low.
For good reason, right.
It's a good reason.
He showed just how big of an impact they can have.
Over time.
Over time.
It's amazing how many people don't even look at that.
They just ignore it.
They ignore it.
They're chasing performance.
Yeah.
But they're not paying attention to how much
they're losing.
It's eating away at their returns.
Right. So simplicity.
Simplicity.
Costs.
What about diversification?
Diversification. Absolutely essential.
Okay.
He believed that owning a broad slice of the market.
So that's owning the whole market.
The whole market.
Not just one sector.
Not trying to pick winners and losers.
Right.
Just own it all.
So less stress.
Way less stress. Yeah.
Okay, less stress. Yeah. And then the other thing is patience.
Patience. Huge advocate for the long game.
Long game.
Yeah.
Don't look at it every day.
Don't check your portfolio every day.
Okay.
You're just going to drive yourself crazy.
Just write it out.
Write it out.
So no panic selling.
No panic selling.
When the market dips.
When the market dips, that's when you buy more.
Buy sell. Okay, I'm starting to get it now.
It's all starting to click.
It's clicking.
Yeah.
Long-term perspective.
Long-term perspective.
And, you know, I think all of this really ties into what Bogle was all about, which was empowering the everyday investor.
He really wanted to help people.
He did, yeah.
Take control of their money.
Their financial future.
Yeah. Cut out the middlemen.
You're in the driver's seat.
Be in charge.
You're in control.
And this is even more important, I feel like, now.
More important than ever.
With all the online tools, the information.
There's so much information at our fingertips.
Bogle was ahead of his time.
A true visionary.
Yeah.
But you know, it's funny. His core principles...
They still apply.
Still apply today.
Yeah.
The simplicity, the low cost, diversification, patience, empowerment.
I mean, it's timeless.
It's timeless advice.
So we covered a lot.
A lot, yeah.
What's your biggest takeaway?
You know, for me, it's just the sense of calm and clarity that Bogle's approach brings, right?
Yeah.
Investing doesn't have to be this crazy, stressful.
Yeah. Like you're gambling.
Right. It can actually be pretty simple and straightforward.
Simple and straightforward.
Even a little bit boring.
Boring but effective.
Boring but effective. That's the Bogle way.
That's the Bogle way.
Yeah.
And I think that's what's so great about it.
Yeah.
He took something that's complicated and made it easy.
Accessible to everyone.
And he did it with integrity.
Integrity, humility.
Yeah.
Genuine desire to help people.
What a guy.
Yeah, truly one of a kind.
Well, on that note, that wraps up our deep dive.
Deep dive complete.
Into the little book of common sense investing.
By the one and only John Bogle.
Hope you learned a lot. We did.
We certainly did, yeah.
And, you know, if you want to learn more, go check out the book.
It's a must-read for any investor.
Absolutely. Until next time.
Happy investing.
Happy investing.